Hey guys, this is Tanner Invest here, and this is going to be my second video on Zeta. If you haven't watched the first one, I'll put it in the description below. I definitely would recommend checking out that where I went over its entire Q1 earnings, and that was really where I did about 10 hours of due diligence, put a lot of info into that video. But this video is just going to be a little more on top of that and some more reasons why I'm bullish on Zeta. You know, lately in the X community, I have seen the Zeta name being thrown around a lot. And I think it's for actually very good reason. And so in this video today, I'm going to get into a couple of interviews. One interview in particular is going to be with the CEO at an event about 2 months ago where he talks about the short report. So we all know that's kind of the big reason why they took a huge hit in November, and what his thoughts are on that. And then I want to also show you a video from a CNBC contributor who's asking. It was a video mostly about his life and his backstory. But, I think when the CEO talks, he gets extremely passionate about the business, and sometimes he starts kind of sales pitching the business a little bit, but it's because he's excited. And I think in this video particularly, he had something that was absolutely mind-blowingly bullish to me, where he said the words, "Forget about TAM." And so I'll leave it at that, and you guys enjoy. Please don't forget to leave a sub, like, and a subscribe if you guys found this useful, and I will be doing some more Zeta content in the future. So real quick, before we hop into those interviews, I just want to show, for those that don't know, what Zeta is. So Zeta is an AI-powered marketing cloud. So they've been using AI now for about 7 years. They've actually filed their first patent like 10 years ago. But what they do is they have a cloud which exists of 550 billion customer profiles. And of those profiles, 245 billion are from American citizens, which makes up about 90% of the adult population. So that means, yes, your data, probably watching this if you're American, and my data, and many others out there, are all within the cloud. And so they take this data and they actually morph it with the first party customer data from their customers. So their customer, say you're a business and you have first party data on this client, and you know exactly when they bought, you know exactly when they've interacted with your website, how long, your email, all those informations. They blend that information with the data that already exists from Zeta's cloud. So Zeta's cloud already has 5,000 to 7,000 data points on each individual customer profile. So they have demographic data, psychographic data. They have, what you're reading. They have things like your financial transactional data, so they know what you've bought, when you've bought it. So all this data, basically what it's doing when they attach this to the first party data from the client, they can really get some key insights to you, but also they can reduce the marketing spend that the client has to incur because they can funnel out a ton of bad data to make sure that the customer is actually targeting the right people at the right time. So first, what Zeta does is they actually remove anyone who's already a customer. So you'd hate to, just to bought a new, Mazda vehicle, and then all of a sudden you're getting a bunch of Mazda ads. I'm sure, you wouldn't be very happy with that. It's kind of like, what the heck? But then Mazda would probably not be very happy because they're spending marketing dollars on someone that just purchased their product, right? Second of all, what they do is they take out unqualified people. So for example, in Mazda, in the same example, they're also going to remove people like people that can't afford a Mazda vehicle, or people that don't have the credit score for a Mazda, right? Or someone who just recently in the past couple months has already purchased a vehicle. So these are ways that using a marketing cloud and using all these data points, a company like Zeta can actually reduce the marketing spend because they're reducing the amount of dollars that they need to spend on advertising by not sending advertising to people that don't buy their product. So they also use things like an intent score. So they can tell if, for example, let's say I'm a big fan of Nikes, and over the past 12 months, I've bought 2 pairs of Nikes and I bought them in 6-month intervals. They know that maybe in another 6 months from now, heck, maybe Adidas is a client, and they'll know, hey, this guy's bought 2 pairs of shoes. He's due for a new pair here in the next few months. So that's another example as to how this is so powerful. And there are a lot of companies in the space now that are competing. What I think makes Zeta a little bit better or a little bit more competitive is that not only do they have their marketing cloud, they also have their own marketing platform, as you see in this little video here right on their website, where the marketing team can actually, from one place, access a portal to see all their campaigns at a glance, their data, their financials behind all their campaigns, and then they can view customer data within the platform as well. So having that all within the platform, they also use AI. They've been, the CTO of the company actually filed for a patent on AI 10 years ago, guys. So they've been very invested into AI prior to the huge AI boom that we're in today. So they're very well suited for the future. And other than that, let's go ahead and get into more about the stock itself. Okay, so we see here Zeta is right now trading at exactly $16. And over the past month, you know, it is a volatile stock, guys. There's been 52 moves in the past year where it's been a 5% up or down on the stock. So like I said, none of this is financial advice. Be very careful when you're investing into, you know, small cap companies like this. But I'm going to get into some reasons why I personally think that this stock has potential to 2x, 3x here in the next 5 years easily. So let's go ahead. And my first video was actually 9 days ago, which is around this little dip here. This is when I really started looking into it because it had trailed down about 10% over the week. And I'd seen a lot of stuff on X. And then I started doing my own research. And I bought in right in this little dip here, which was nice because I'm already up, as you see, about 12% on a $3,500 position. I do plan on adding to this. Right now, I have no dry powder. Honestly, I'm fully invested. So I'm actually waiting for earnings here at the end of this month. I have a couple stocks that I'm kind of thinking I might trim some positions and then add some more into Zeta. But first off, let's go ahead and explain this. Okay, so let's go to their 1 year chart. In my last video, I kind of explained this, but I want to explain it real quick again. They were attacked by a short report. So what happens is, in a short report, someone out there working for some company has that is interested in shorting the stock will create a report on shorting the stock. And this is on this day, as you see this massive dip in November. Now, the funny thing about this short report is it had so much false information that's been proven to be false. For example, the auditing company that the short report said that Zeta was using was the wrong auditing firm. So they had so much information that was just BS to get other shorts in on the stock, and it actually worked. It actually brought the stock down quite a bit. Real quick, I want to show you a video from the CEO himself after he was asked 2 months ago. So this was, let's see if I can find the date. May 19th was when this video was uploaded, so it was probably around this time. But the CEO had some comments regarding the short report. So let me go ahead and mute my mic so you don't hear two audios.
We felt it was very important, Terry, that we set the record straight, and we brought in, our audit committee brought in a forensic accounting firm. We brought in the top law firms in Washington, D.C. in the world. They did a full audit of our financials. They did a full audit of our data practices, and they found zero merit to all of those things. So we felt it was very important to be aggressive about making it clear that these were lies about our company. Right. And, you know, listen, you sort of take it in the shorts whether you like it or not, literally and figuratively. Right. And, you know, you just build back. And from my research, generally it takes between 2 and 4 quarters of executing to get back to where you were. We're halfway in that process. Right. That happened in very...
So if we can agree with the CEO here, and he's not a complete snake oil salesman, do you think that perhaps if he's telling the truth, that maybe this dip in the stock isn't merited? So now where do we go from here, right? This dip in the stock that's going back from November, you heard him. He said, you know, typically takes 6 to 12 months to actually recover. And we are not quite 12 months away. We're a little past 6 months away. So we're still super dipped from his research, but you know, I don't know if that's completely true or not. Obviously, you have to execute at a high level for that to be true. But we see here that they are still down in the past year, 23%, and from their highs, they're down significantly more than that. So now, if we can take a look at their stock from a different lens, so say this never happened, say we're just purely looking at it from a fundamental level, which is what I plan to do as an investor, and I'm going to get into more of that later. We need to look at where it is now and where it's going from here, and where the stock price is and where that's going from here. So I do want to talk about this bullish talk that he had with Fortt Knox. Now, this video I do recommend, if you're a big investor in the company, you want to know everything about the company like I do. This interview was more about Steinberg's like life history and him growing up and how he was raised and how he's dyslexic and ADHD and somehow became the CEO of this massive company. So it's really cool to learn or listen to. But the main point I got from this is a really, really cool point here is in the world of investing, you hear the word TAM a lot, which is an acronym for total addressable market. I hear this all the time too because I'm in tech sales and we talk about our TAM. But within the marketing, it's like, what is the overall size of the market? What Steinberg makes a huge point here, and what I talked about in my latest video, was that they have a ton of customers already, right? And these customers are already spending a lot of money, and they have a positive over 100%, which is 114% to be exact, net retention rate. So that means that customers, even if they were to stop doing business and stop gaining new customers, the ones they have today will be buying more of their software, but more of their marketing spend. So 114% more to be exact, which means their customers are happy, they're spending more. That's great. So here he says the quote, "Forget about TAM," and this really stood out to me. Let's check this out.
Existing 548 global enterprise clients spend over $100 billion a year on marketing today. So forget about TAM. Everybody likes to talk about what's their TAM. Our existing customers spend $100 billion a year. Last year, we had 1% market share. My long-term goal is to get to 5 to 10% wallet share from my clients. And we've just been scaling with our existing clients. And by the way, we've been adding additional clients.
So sorry guys, I had that in a little speed. I put everything in speed and my playback speed higher. I recommend doing the same with my videos because I kind of talk a little slow sometimes. But this is so bullish to me, guys. He says they have 548 existing clients that spend, from those clients that are massive, obviously, they spend over $100 billion in marketing a year. And right now, from that marketing, some of it goes to TV ads, some of it goes to influencers, some of it goes to, in affiliate marketing, some of it goes to radio ads, some of it goes to billboards. Now, some of it goes to places like Zeta or Trade Desk, where you're trying to have them kind of push it out in multiple directions through Google ads, YouTube, things like that. Now, he says, forget about TAM because they have so many clients. Last year, of those 548 clients and that $100 billion, they only have 1%, which checks out because they have $1 billion in revenue last year, right? So they have 1%, and they're looking to expand that to 5 to 10%, which if you do the math, that means they're looking to expand their annual revenue from 5 billion to 10 billion, and obviously growing from there. So that to me is extremely bullish. Now, real quick, I want to go ahead and get into some of the more fundamentals that we kind of have talked about from here. And I also want to run some actual math with you guys, just so we're all on the same page. I know I get a lot of comments, telling me they don't quite understand things I'm talking about, or they're asking a little bit deeper questions that I should have maybe explained better. So today I'm going to just do the math alongside you guys so we can take a look at a couple things. I think what's really important is the price to sales. And I'm comparing, you see on the left here, I have Zeta, and on the right, I have the Trade Desk. The reason I have the Trade Desk is because they are both in the ad tech space, advertising tech. Zeta is actually arguably also in the marketing tech, which is also known as MarTech. But the Trade Desk is trading just way more expensive. Actually, the Trade Desk, congrats to those shareholders because they just got into the S&P within the last week. Actually, kind of last week and a half. And then Square got in, which is XYZ. Anyway. So let's do some math here because this price to sales number is really sticking out to me. The price to free cash flow, the forward PE, these are all numbers I like to look at. The price to sales specifically, when you compare the two, Zeta right now is trading at a 3.48 price to sales, and Trade Desk is trading at a 16.21 price to sales. That, if you do the math, that's 5 times, give or take, 5 times more. So let's go ahead and just do the math on how you get price to sales and what exactly that means. And then what I want to do is, in their presentation, which I'll go back to my other screen real quick, in their last quarter presentation, they gave us guidance. So they do guidance every 3 years out. So the last time they did guidance was in 2022, and they actually crush those numbers, it's actually right here. So you can see, announced in February 2022, this was their original model of guidance. Their actual performance is actually this second block. And then 2028 model, they announced in February 2025. This is where they're projecting their company to be with 20% revenue CAGR, adjusted EBITDA CAGR, and their free cash flow CAGR over the next 3 years. So I'm going to use this data just to say, hey, we already know the last 3 years, they blew it out of the water on performance. The next 3 year, maybe they'll blow it out of the water again. But I'm just going to use the numbers they gave me, which I think they might be sandbagging just a little bit, which companies are kind of known to do. But as you see here, right now, this is their 2024. They had a little over $1 billion in sales. 2025, they're estimating a little over 1.2 billion, but by 2028, they're estimating at 2.1 billion in sales. So I think they're trading at a really low multiple price to earnings growth. They're trading at a very low multiple on price to sales, like I already talked about. So let's just keep everything even. Let's say in the next 3 years, they're still trading at the same price to sales, but they actually hit this $2.1 billion revenue number. Then I'm going to back it into what will the stock price be, or what should it be, based on if there were no dilution or no buybacks, which we already know they're buying back shares, so that number actually should go down. But I'm going to do all the math with you guys here. So let's go ahead and jump into this. I have the calculator pulled up. So to get the price to sales, it's a very easy calculation. You take this number, the market capitalization of the company, and you divide by the sales. Okay, so let's go ahead and take, and I'm just going to type all this out. So 374 billion. So this is 3.74 billion. We're going to divide that by their sales of 1.8 billion. And we click enter. That is where you get this 3.462. They have it 3.8 because they have, this is rounding, of course, but that's the same number, okay, based on if there were no rounding at all. And so now this 3.46 number here, we can multiply that, for example, by their estimated sales. So right now we're at 1.08 billion. So let's go back to this other sheet real quick. And we have right here where they're estimating in 2028, 2.1 billion. So let's multiply our price to sales, based off of, which is right here. And let's base this off of 2.1 billion. So we just multiply this by 2.1. Let me just make sure that's correct. 333. Yep. So this is now the new market cap. If they had the same exact price to sales and they had 2.1 billion in sales, now we know that the numerator on this equation of price to sales would be the market cap. So the market cap now is 7.2 billion. Okay. So now you can divide 7.2 billion divided by the amount of shares outstanding. So that's the market cap divided by the shares outstanding to get the stock price of what it would be. So we know here using FinViz, shout out to FinViz, we have 211.97 million. So let's go ahead and put in here. Sorry, my keyboard sometimes doesn't like to work whenever I'm switching back and forth. So right now, 211.97 million. And we are at a $34 share price. That is insane, guys. So 34.3 million $34.3 would be the share price if in 2028 they hit the revenue target, not exceeded it, just hit it, and they have the exact same price to share and they have no dilution or stock buybacks. So the shares stayed the same, which is unlikely. They actually released a $100 million share buyback program within the last year. So now let's go ahead and calculate something else, guys. Let's calculate if, for example, for whatever reason, let's say they were to match the price to sales for the trade desk. Now we have this 16.21 number, right, times their sales, which would be 2.1 billion. Okay, so let's go ahead and go here again. So what was that number? Yeah, I'm sorry, 16.21. Okay, 16.21. multiplied by 2.1 billion. And now you have this market cap, $334 billion market cap, and then you divide this by the shares outstanding. You get a $160 share price. I mean, that's pretty crazy, isn't it? So this is why I think, in my estimation, in the next 3 years, I could see the stock going from where it is today at $16 and at least getting to $34. But the potential with increased multiple in a better price to sales ratio, essentially, getting to potentially a lot higher. Now, obviously, Trade Desk and Zeta are different companies. I just wanted to compare someone similar within the space, one of their competitors. And because really, I think the reasoning behind Zeta trading so low at this low price to sale ratio and this low price to earnings ratio is because, let's be real, guys, like this short report did this company pretty dirty, and it still really hasn't recovered since then. So I really appreciate the time today, guys. I'm going to keep posting more video content about this. I appreciate the follows. I appreciate the subscriptions. I hope you guys are learning a little bit more about Zeta. And yeah, see you guys later. Thank you.